is integrated into every aspect of our lives. From finance to defence, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom Mackenzie in London. Watch the new Bloomberg Tech Europe. Premieres June 13th, only on Bloomberg Television.
Welcome back. It is 7:17 here in London. The picture for the futures equity market looks pretty mixed, pretty flat, actually. US futures look flat and mixed right now. The stage is set then for day two, an unexpected day two, perhaps, of the China-US conversations around trade. Yesterday we heard from the president. He said that good progress was being made. He hears only good things coming from the room. That's the US side. What can we realistically expect from this round of talks, though, between the US and China on trade? Let's talk to Bilal Hafeez, CEO of Macro Hive, who joins us around the desk this morning. Bilal, nice to have you with us. So we're waiting for the next day of conversations. That's in a few hours' time. That looks set to kick off. How high should our expectations be here? Because on the one hand, this might just be about rare earths and chips. You know, the Chinese give a bit on rare earths, the US gives a bit on chips. Would that meet expectations in the market? Would that be enough to shore up sentiment around this particular relationship?
I mean, I think beyond very short-term dynamics, I think our expectations should be very low because I think that what we've seen from the Geneva talks, the London talks now, is that this is going to be a protracted, long period of discussions between the two. The larger issue of like the size of tariffs across all sectors, not just between these narrow sectors, the requirement for China possibly to buy more US goods, all of these things will take a long time to sort out. And we have to remember from Trump 1.0, the Chinese promised to buy a huge amount of US goods. They didn't. Chinese say it was because of COVID. The US said they didn't sort of meet their promises. So I think it's a long haul that we're in for.
So on the one hand, the expectations are around the short term and how we prevent going back to tariffs of more than 100% on parts of this relationship. On the longer term, though, this could be about entirely reshaping the global trading order. Where should markets be placing themselves in amongst all of that, Bilal?
I mean, my personal view is I think we're going through a huge regime change, a complete realignment of the trading order, which is akin to what we saw with the breakdown of Bretton Woods in the early 1970s. And I think most investors just don't have the patience to follow a theme like that. So I think this is huge. And the problem for investors is that these types of realignments, what the Chinese are planning, what the US wants, how the Europeans act, they act on a much slower timeline compared to investors who have a time horizon of around 24 hours, if that.
So what should they be doing? What's the right track? If you have a longer-term time horizon, and every investor that sits around here says, oh, it's all about time horizons, so we should probably focus on that. What should you be doing? How do you wait? Do you sit on the sidelines? Do you try and trade it? How do you play that kind of a world? If you're a portfolio manager watching right now and you're trying to get a framework, what does that framework look like?
I mean, for me, the three things you do. Number one is you sell the dollar, because I think the dollar is going to be a multi-year downtrend. It happened in the 1970s after Bretton Woods broke down. For 10 years, the dollar went down. The second thing is you have some kind of short rates trade. So for me, curve steepening makes most sense. That long-end interest rates are going to go up around the world as capital kind of comes back to everyone's sort of home. And the third is on the equity side, you just go long defense stocks. You know,
and there's more still to come on that.
Absolutely, yeah. There's more to go on that side.
So there's more, but there's more on all of those trades.
More on all of those trades. We're just at the beginning, stage one of multi-stage process.
Give me an order of magnitude.
For example, on say the dollar, say euro dollar, I think we could go to say 140. That's the type of
140.
140, absolutely.
On euro dollar.
On euro dollar, that's
we're
the type
at
of scale.
114 right now.
Well, 114, yeah, it's 114.
That's why I had to check.
Yes.
This is the scale of moves.
Over what time frame?
This could be within 1 or 2 years. That's the type of scale.
Fast.
That's fast. Absolutely. Yeah. I mean, if you look at how fast the dollar fell from 2002 to 2004, it was similarly large as this I'm describing. Early 70s is way larger than that. So for me, it's not out of the realms of possibility.
So I'm just sitting here with my jaw slightly open. 140, I can't quite get...
Yeah.
Yeah. So take us to the US economy. I mean, does the underlying state of the US economy matter in that trade? It seems as if interest rate differentials and the state of the US economy may be pushed to the sideline by this broader big picture narrative that you described.
Absolutely, yeah. The normal cyclical dynamics, that's much less important with this type of structural change, because, number one, when you are trying to forecast the US economy, you have to factor in these tariffs and all of these other dynamics, which brings the international order into the equation. Secondly, you have the Fed that's going to try to have to understand how this shift in the international order will affect interest rates. And so normally when interest rates go up, it's good for a currency, but instead what may be happening is interest rates may be going up to reflect some kind of risk premium that investors are worried about the dollar. So it's kind of more like an EM dynamic. So there's normal drivers won't be as important for the dollar.
And that the ECB might have been hoping for some more of those normal drivers to support exports, I suppose. They wouldn't be maybe happy with 140? I mean,
absolutely not. No, no, they won't be happy with 140 at all. I mean, nobody will be happy with a stronger currency. But of course, there has to be an outlet somewhere for dollar weakness.
Isn't AI going to save us? Isn't the AI trade going to keep us invested in the United States?
Well, AI, I think, will help a lot of stocks, I think. But interestingly, I've been speaking to lots of investors, including Silicon Valley. It seems like the big shift now is much more towards defense tech, which is the point I alluded to earlier. People are kind of realigning or rebranding or whatever you want to call it, their portfolios away from AI towards defense tech or defense AI. So that seems to be the bigger growth area. And one reason for that is that's where the government money is going across the world. And so you want to follow where government money is going, and so you get more support from that side.
And are we confident governments can get into defence tech rather than just into big defence in the way that they maybe have, falling back on old themes?
Yeah, I mean, I think it's always governments. I mean, even at the moment, when you look at defence spending in Europe, a lot of it seems to be on like building roads and building broadband. It's not even related to even old tech. But if you look at modern warfare, like drone, AI sort of driven drone attacks and so on, so that you can see how AI fits into that equation.
Has Europe got enough money to do all that? I know Germany has, but you do want a deficit's going to stop the kind of spending that may ultimately be desired by governments. Is the bond market going to resist?
Yeah, I think ultimately it will resist in some form. One form will be the curves will steepen. That will put a lot more pressure on governments. But we do know within Europe, Germany has a lot of fiscal capacity.
Germany has?
Yeah, so they could anchor the European side. Moreover, if you look at it from a capital flow perspective, Europe has a current account surplus. So they're a net saver to the rest of the world. So that means that if they just kept the money at home, there's enough domestic savings.
How do you keep the money at home?
Offering opportunities for people to invest domestically. Right. So, for example, just offer high yields. That's one, way. Offer sectors that people think could grow. Already, DAX and European stocks have outperformed the US stocks this year to date. So already you see a relative equity outperformance.
Bilal, one of the other things you pick up on in your notes is that energy is driving everything. What is the way to play energy trades at this point?
Yeah, no, I mean, the energy trade, I think you just have to have a sort of a multi-pronged, attack. So whether that's, long sort of fossil fuels, long nuclear, long sort of renewables in some form. And this goes back to the AI point, which is that the data center requirements, AI energy needs are so large, and they're going to increase going forward, that we're going to hit this kind of limit on the amount of energy that we have. So just long energy in multiple different formats, I think, make a lot of sense.
Is the rest of the economy in competition with AI for that energy? Is there going to be enough?
Yeah, absolutely. They will be in competition, and I think that's what the urgency is. And one of the things we've been finding is that if you look at, say, China's policy on energy, what they've done is they've maintained their fossil fuel, hydrocarbons. They've gone into nuclear, and they've gone into renewables. Whereas what Western economies have done is they've done a competition between those different sources of energy, like less fossil fuels, more renewables, or vice versa. Whereas China's gone all in on all of them, which seems to have held them good stead so far.
Just to come back to the 140, which I can't get away from. Don't you sell European stocks at 140? This is going to be disastrous for the European export sector.
It will be, yeah. I mean, European export sectors, I think, in general, have been under fire a lot because of Chinese exports, for one.
Yeah.
But I think what could work is domestic European stocks, more domestically orientated stocks to do well. But you're right. In general, a level of euro at that that level of euro will not be good for Europe.
Do I sell travel companies? A lot of Americans have been coming to Europe over the last few years because the euro's been on the floor. Does that? What are the? Just walk me through the implications of a one.
Yeah, I mean, the implications would be there'll be a cyclical hit to the European economy.
Yeah.
So European growth would be weaker than it otherwise would be. You'd have this disinflationary shock that would hit Europe.
Yep.
And already there's a lot of speculation about whether the Chinese will simply dump all of their US goods into Europe.
Yep.
Now the Europeans are saying, no, that won't happen, but if that does happen. So you suddenly end up in this kind of interesting dynamic where Europe could have this disinflationary trend because of a stronger euro.
Yep.
You have weaker cycle, yet you have a very strong currency.
Yeah. Wow. Okay. I've got a lot of things to think about around that. Bilal, great to see you. Thanks very much indeed for joining us. The CEO of Macro. Hi, Bilal Hafeez. Coming up, we're going to talk more about what is happening in the bond market. That story is next. And I'll decide is going to be joining us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang. Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. 30 minutes from the start of European equity trading and the futures picture. I'm not sure it does quite does service to the news flow that we could get today around the China and the US, or maybe we don't get much, and therefore these expectations are pretty sensible. US futures pretty flat as well. Are we really, Guy, expecting just a deal around chips and rare earths between the Chinese and the US, just a reaffirmation of the Geneva agenda, or are we really going to make any more progress? The market is watching.
The market's rolled over a little bit. So US equity futures have certainly rolled over a little bit. When I came in first thing this morning, they were up a little bit more than they are. So sentiment's taken a bit of a hit. take a look at what is happening with dollar yen as well. In terms of the bond market this morning, you do have a bit of a bid back into the bond market. Yields are a little bit lower this morning, certainly over in the United States, and you're seeing that across Europe as well. Not a great deal of movement, though. I think everybody's waiting and watching to see exactly what's going to come out of these talks and figure out exactly what the implications of that all mean. But you've also got the LA story to factor in, you've got the immigration story, you've got all kinds of other things that you need to be folding into this story too. NFIB's coming out a little bit later as well. But let's talk about these trade talks and where the bar is. Valerie Teitel is here to set it for us.
Okay, I'll try to do that. But yeah, I thought it was interesting that the U.S. dollar continues to act positively to positive news on trade. That's one bullish tilt for the U.S. dollar. The Bloomberg Dollar Spot Index is just slightly higher this morning, up 0.1%. We're still hovering around year-to-date lows, around multi-year lows, so it might take a heck of a lot of optimism coming out of these trade talks so we can significantly break out higher from there. But the other thing that can shift the dollar is tomorrow's CPI print. I thought it was very interesting that yesterday's New York Fed survey saw that inflation expectations across the board declined. One-year inflation expectations, which was the one indicator that had been creeping higher, tilted down, as well as 3-year and 5-year. So medium-term inflation expectations also turned around. It does seem like the consumer is less anxious when it comes to CPI. It also seems like economists are less worried when it comes to CPI as well. Take a look at this next chart. This is the 2025 year-end forecast for economists. It's a consensus estimate across the street. You can see here how the CPI estimate peaked around 320, but we've taken a small hit. We're now around 3%. That is still assuming around a 70 basis point rise in CPI, but I found it interesting that both consumers and economists seem to be shifting down their expectations for inflation.
Okay, nice place to start our conversation. Valerie, come and join us around the desk for that. Sonal Desai joins us, CIO and Head of Fixed Income at Franklin Templeton. Sonal, very nice to have you with us. Thank you for being with us so early this morning. Let's talk about inflation expectations and how much they're driving your world and how much this is all about other things. We'll come to, no doubt, in a moment. But Valerie, there just setting up nicely how it seems that inflation expectations amongst the public and then economists coming down, despite the fact that we've got tariffs and the outlook for tariffs a little unclear. Tariffs could go higher, for example, between the US and China than they are right now. What do you make of declining inflation expectations?
So thanks for having me here this morning. But Anna, I'd actually say that coming into this year, I was pessimistic relative to the market in terms of where we expected inflation to end this year at. I just didn't think inflation was coming down as quickly as people expected. The reverse of that was once we started talking about tariffs, I didn't think tariffs were going to have as much of an inflationary impact as certainly consumers were anticipating. And that comes down to, frankly, how small the impact of tariffs is on the broader CPI and indeed on the US economy. If you just look at the size of the economy and the piece of the economy that tariffs actually impact. So when you talk about 3%, that's roughly where I started off around November of last year. And now the market is coming around to thinking around 3%. And I think that's reasonable. But the consumers in particular, I think, seem to be driven very much by day-to-day movements of headlines regarding tariffs and also, of course, oil prices and gas prices. So I think that's what's going on with the consumer side.
So your call for year-end inflation is around where economists' estimates, around 3%.
But it has been there for a long time.
Another 75 basis point rise from where CPI was last month. How do you expect the Fed to message that? Do you think they'll continue to cut rates in the face of inflation rising?
So I think cut rates in plural, probably not. But again, I've been calling. I think they will probably cut once because they've been guiding towards a maximum of one rate cut. And I think they could well deliver that, especially if we get, just a surface decline in CPI of a little bit. I think they could do that.
What does one rate cut do?
Nothing. Honestly, really nothing. If you were thinking about why would they do even one, mostly I would say to meet some broad notion of where the market expects them to go. If between now and if they don't signal that they're really open to not cutting at all, I think they'll probably cut. But honestly, it doesn't do very much. It's a question of where you think neutral rates are. Right, I've been calling for the Fed funds nominal neutral rate to be between 4 and 4.25 for a very long time. So in my mind, they've got within their gift a quarter basis points to give without too much of damage being done on either side. But would it be smart to not cut at all? Probably, But there is, on the margins, have you seen a little bit of rebalancing on the labor market? Some, so enough to justify a token cut, but not enough to do much more.
Those with debt to service might be glad if they do get even just one rate cut, maybe preferring more. How, with that in mind, fiscal sustainability is something that has been driving the long end of the bond market in the United States. How much of a preoccupation is that for you, Sonal?
It's been a preoccupation for about 5 years. So I'd say that the bond market and markets in general are finally coming back to keeping an eye on the ball, because let's remember, we've been running 6 to 6.5% of GDP budget deficits for 4 years when the U.S. economy has actually been growing very, very handsomely. And while monetary policy, the Fed did raise rates, it was, it wasn't massively restrictive relative to where inflation was. So
do you see yields breaking out higher from here? I mean, we almost tested the cycle highs and the 30-year yields a few weeks ago, and we didn't break through it. What do you think would be the catalyst for breaking up to through cycle highs in the long end?
So if we're talking about breaking through cycle highs, I'm not looking for near-term movements, because those are, again, very sentiment and technicals driven. When we broke through the last time, it actually started in Japan. It didn't start in the US. So, there was really a global move higher in rates. So if I think more longer term, the utter lack of any desire for fiscal consolidation from either the Democrats or the Republicans pretty much assures us that yield curves are going to go steeper, absent a dramatic recession in the US, right? And that's not just the US.
Our last guest was talking about 140 on euro dollar, which seems like...
On euro dollar, yes. It's not dollar yen, just for the avoidance of doubt. Euro dollar.
So I think...
What do you think, what are interest rate differentials going to look like? Because in some ways, logically, the euro should be lower right now, not higher, but it's higher.
So it's a combination, I think. Starting conditions matter. Let's put it this way. We entered this year, which is something which is being handsomely forgotten, I'd say, generally. But we came into this year with DXY in general, especially dollar yen and dollar euro, at highs which we've not seen since the Plaza Accords. We're talking about 40-year strength as far as the dollar is concerned, 40, 50-year strength in the dollar. And we have given up some of it. Most people think that fair value for the euro even is around 118. It was as recently as 2020, 2021 that we had around 120, 120, talking about 140, right? 140, 140. We were at 120, 120, dollar and dollar yen, dollar euro, dollar yen, as recently as 2020, 2021.
Okay.
So getting some more euro weakness is definitely, dollar weakness is definitely in the cards. But could we overshoot? Maybe, but you'd need some kind of a trigger, as you mentioned, for that overshoot. I don't know where that comes from right now. But definitely, could we go through a period of greater dollar weakness or more protracted dollar weakness? We could. But I don't think anything dramatic is happening with, so I hear a lot of talk about, the dollar's loss as a reserve currency, the loss of US credibility. I think that is putting a lot of burden on 3 or 4 months of the dollar retracting from
it feels dramatic. I think that's the thing. It feels dramatic.
Several decades.
And the narrative from the US administration feels dramatic.
That I agree. And you actually had a few things which happened in, you had a perfect storm, starting off with DeepSeek, followed up in short order by the Germans announcing this massive fiscal spend. So suddenly people thought, okay, this is going to change Europe's trajectory. And finally you had Liberation Day, so you had the perfect storm to get people to really start getting worried about the US. But where we've gone, I mean...
it's funny you were talking about the beginning of the year, because the beginning of the year, the whole narrative is that tariffs were going to cause dollar strength. And how wrong were we about that? What did the markets get wrong about that kind of conclusion?
I think it was a very simple theoretical conclusion, which is that, okay, the country which is imposing tariffs in some way, their currency needs to weaken. But beyond that, I think we have markets love trends, right? So you had the Magnificent Seven, you had unprecedented portfolio flows into the US for 2 years, and it's a little bit like a machine. If it's going to go in a certain direction, it's just going to continue going in that direction. So I actually hesitate to attribute deep thought to the idea of massive dollar strength.
What's in the early stages of a momentum shift that I'm watching out for? What are you kind of picking up on right now? Are there any trends that are emerging that we should be paying attention to now?
I don't think there are massive trends, but one thing I would note is this desire to have immediate outcomes, you know, so the big calls. I think it might not work that way, because while the US does not look attractive from a fiscal perspective, it isn't as if many countries look fabulous. Let's put it this way, you know. So if I look around the world, I would expect yields to go up quite globally. And so there are shifts happening. There would be a reversion, you know, especially if you look in countries like Japan, you know. And you can see to some extent the BOJ already pushing back gently against this this morning. And you can see that. So nobody's super comfortable with dramatic moves in exchange rates happening, apart from the US, which doesn't really care. But I'd say some of what we're seeing, I would anticipate more of slow grinds. So I don't think we're going to see a resolution coming out of these talks in London. I think any expectation of that is probably likely to result in disappointment, because these are very, very complicated discussions. Tectonic. And I think the idea of the US dramatically lowering its barriers to exports of high-tech chips to China, there's going to be a lot of domestic resistance to that, you know, from Congress. So it's going to be a very complicated discussion altogether. So
3D, 4D chess, whatever we want to talk about.
Well,
Nice to see you. Thanks for talking about it so bright and early this morning. We really appreciate it. Sunil Desai, CIO of Fixed Income at Franklin Templeton. Valerie's going to be back a little bit later on. Coming up on the show, we're going to turn our attention to what is happening with Apple unveiling its most sweeping software redesign yet. Investors, though, focused on AI, left wanting a little more. We're going to look at how Apple supplier stocks are reacting to all of that. We'll do that next. Stocks to watch coming up. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
"30 minutes to go, 40 minutes to go until the opening trade. At the moment, you have a very inconclusive picture in front of you on the screen from the data telling you about where the session is going to go. We need clarity. One thing we definitely need clarity on is what is happening with these day two talks that are happening between the United States and China. We're waiting for news. I think Besson's got to go home, so I think he's got to go to Congress. So I think today might be the final day, but I don't know. So let's try and find out. I want to take you down to St. James's. There we find Bloomberg's Lizzie Burden tracking the negotiations, anticipating what is going to be happening. Let's talk about where we are at the moment, this morning, Tuesday morning. What progress, if any, has been made? What's going on, Lizzie?
Well, good morning, Guy, from Lancaster House. And you might remember this location as where they had the UK-EU summit just a few weeks ago. We're round the corner from Buckingham Palace, and they were in there for more than 6 hours yesterday, thrashing out the details. We're back for day two. And at the moment, it looks like the bottom line is that the US is going to send more chips to China in exchange for China sending more rare earths to the US. This is what we were expecting anyway, because we knew that Commerce Secretary Howard Lutnick would be here alongside the US Treasury Secretary Scott Bessent and the US Trade Representative Jamieson Greer. And it had long been a source of frustration for Beijing that the US weren't sending somebody with the authority to deal on export controls. So it was a sign of goodwill that Lutnick was round the table. But then we heard from Kevin Hassett yesterday, the head of the White House National Economic Council, saying that the chips that are going to be sent will not include the most sophisticated chips, NVIDIA's H20 chips to be specific. And this is important because it's been a long-standing bipartisan issue in Washington politics that the US doesn't want to send its most advanced chips to China. But in terms of the rest of what will be sent, what we know, what we think we know, is that there'll be other chip design software, jet engine parts, and chemical and nuclear materials. So the point being, they're trying to ride back some of that acrimony that's built up since the Geneva Agreement.
Yes, so if that's what we're watching then, Lizzie, from all our reporting, that seems to be what we get here. What